Hello, everybody. This is Manoj Kulwal from IOR. I am your host today. Welcome to the session today. Our expert speaker today is Gary Beers, who is joining us from US. Gary has over 30 years of experience covering strategy, risk, financial, and performance management. He's the founder and CEO of RPM3 Solutions, and inventor of company's patented ARQ methodology, which is what he's going to share with us today. So one of the things I get to boast is that I know a risk management practitioner who actually holds a patent on a risk management topic, because I haven't found anybody else in the risk management discipline who holds a patent. So that's really unique for me. In his previous role as Director Global Risk Management for Moore Corporation Limited, he was appointed by the CEO as champion of Moore's ERM initiative. So he was responsible for ERM before we had standards like COSO and ISO 31000 between 1997 and 2000. So he's really one of the true innovators in the risk management space, and one of the drivers behind. One of the drivers for Gary has been that before coming into risk management, he was a CFO, so he came from a very financial background. And when he came into the risk management space, he was a little disappointed with the high, medium, low risk exposure language, which was being used in the risk management space. And because of his financial background, he really wanted to come up with ideas and solutions on how risk management can be quantified, because that's what his CEO, his board was really asking for. So Gary can share a little bit more about that, but that's really the driver behind the session today, where he's going to share his patented methodology around how do we calculate the cost of managing different categories of risk in our organization, and how do we see whether increasing or decreasing the cost of risk management influences the revenue and the profitability and the performance of the organization. So it's not just about the cost, but how does that cost connect to the strategy of the organization. So before I hand over the floor to Gary, we have some new attendees. So I just want to quickly do an introduction of IOR and talk about the certification initiative for the first 3 or 4 minutes, and then I'll hand over the floor to Gary. So IOR, for people who are attending who are not aware, is the Institute of Operational Risk. It's a global member-based organization run by the operational risk management professionals for the operational risk management professionals. And the mission of the organization is to promote development of the operational risk discipline globally. And the way the Institute does that is by developing and sharing practical guidance with practitioners. So the Institute has published around 10 practice guidance, which are available on the website on various topics like risk assessments, key risk indicators, risk appetite, loss events. So that's one of the most famous or one of the most visited areas on the IOR website. So we know a lot of people value that guidance which is being shared. The Institute has also developed independent professional certification, which I'm going to talk about on the next slide. The Institute also undertakes research on emerging topics. So we have a big global survey going on currently, where we partnered with Center for Financial Professionals, and then the outcome of that research will be presented at the Next Generation Operational Risk Conference in March in London. And then the last but not the least important item is that we also organize various events. So IOR has various chapters around the world. So we organize a lot of physical events where we get operational risk practitioners together to discuss a specific topic. And then we also organize webinars like the one today, for members who may not be able to physically visit the events we organize. I mentioned about this certification, so I just want to briefly introduce that. So in May this year is when IOR introduced the Certificate of Operational Risk Management. So this is a new professional certification for practitioners who may be new to operational risk, and hence they need to demonstrate, to their organization, to their managers, to their, future employers, that they understand the concepts, the foundational concepts of operational risk management. So it's targeted for those practitioners. So we have a lot of professionals from audit, compliance, IT who may join the operational risk team, and then this certification is a good way for them to learn all the foundation concepts about operational risk and then pass an exam to then get a external validation or external certification that they really understand the concepts of operational risk. So it's accredited by ATHE, which is regulated by Ofqual. In UK, it's equivalent to QCF Level 4, which is a pre-degree course, and in Europe, it's equivalent of EQF Level 5. The study method is self-learning, so once you register for the certification, it's self-learning. You get a workbook which covers the 9 chapters, and the topics are listed on the right-hand side on the slide there. And from experience, it typically takes 130 to 150 hours of study before you can be ready for an exam. And the exam is done all online, so you don't have to go anywhere to appear for the exam. You just need a computer, and then the requirements are provided before you attend the course. And then there will be an online invigilator who would be watching you during the exam. The exam is 50 multiple choice questions which you have to answer in 75 minutes. And the fee for the entire certification is 550 plus VAT if you're based in UK. And that includes the workbook. It also includes the exam fee. And if you're not an IOR member, you will also get the 1-year IOR associate membership as part of that. Okay. So there are more details available on the IOR website around the certification. So if either you are new to the operational risk management discipline, or if you have anybody in your team who's new to the operational risk management discipline and could benefit from learning the foundation concept from created by other practitioners, then please do consider this certification. So today's session, so for people who have attended the previous session, you would notice that we've expanded the format because we were seeing that 60 minutes was a struggle, that just when the speaker was warming up, we had to try and close the session. So we're trying to extend the format to 90 minutes, so that gives ample time for the speaker to cover the topics, and also for you to ask relevant questions and get the answer. So we'll try this format and see how this format works today. But the format is going to be similar to the previous session, where we will have it as a discussion between Gary and me, and you can join the discussion by posting your questions. So I will keep an eye on the question area where you can post your question, and then if your question is related to something Gary is discussing at that moment, then I can ask him the question at that point. Or if your question is more generic, then I'll leave it towards the end. So I'll leave some time towards the end, to then address the questions, which may be slightly outside the flow of what Gary is covering. The slides and recordings will be available in the members area on the IOR website if you need access to that. So with that, let me hand over the floor to Gary. So Gary, I'll just make you the presenter now, and let's see if you are able to share. I can confirm then that we are able to see your screen. Okay, perfect. Yeah, we're able to see your screen. So all over to you, Gary.
Well, thank you, Manoj. One thing I would like to add, going back to the genesis of all this measurement, back in the late 90s, leading into 2000, a lot of people thought of this stuff theoretically, but it was very difficult for the board and for senior management. It could be the same for people today, to really grasp it and find its value as being part of the essential business management function, if there wasn't some way of connecting it to the bottom line. And that kind of drove the development of this patent. to get something for us in risk management that we can use that creates sort of like a barometer of what's happening in the organization from a risk health perspective. So the key here is that this is not intending, and I've had people ask me this question before, Manoj, that this is not intending to look over the horizon like risk assessment. This is intended to look through the rear view mirror and get a sense of how has risk affected us. So, how well have we been doing and how healthy are we with regard to our risk management practices? So that's a really important backdrop, as we move forward with discussing ARQ and the enterprise-wide total cost of risk. So Manoj, what I'm going to do today, if it's all right with you, I'd like to start off the first half of the presentation, so to speak, is going to be more about what is this enterprise-wide total cost of risk, and what is it, where does it come from, and why is it important? Then I'll transition into the patent and looking at the ARQ methodology, which is the methodology to calculate enterprise-wide total cost of risk. And then I'm hoping that we can sort of answer some of the questions near the end of why should anyone care, and and then move on to maybe getting into our software, which is a electronic apparatus that's under the patent to do all this. And we can discuss that, why you would want to have an automated approach and that sort of thing near the end. And I'm crossing my fingers we'll get all this done and give people plenty of time for questions, if that is okay for you.
Sure, that'll be perfect. Yeah, and then hopefully I will also get questions during the session, so it'll become a discussion format. But I think that structure sounds great. So because in my training, when I sort of bring this concept, not many people are aware that there is a formal theory or a formal way of calculating total cost of risk. So it'll be good to sort of start with that of the foundation, and then we can talk about your patent and sort of why that is unique and how that can add value to the risk management discipline.
Okay. Well, shall we dive in?
Okay. Yeah, we're ready to go.
So let's talk about total cost of risk. Many people on the line are probably familiar with the term. It's been around for a very long time. It originated probably in more the insurance management function, where the Risk and Insurance Management Society started using the term total cost of risk to look at the insurable risks of an organization. So the notion being that when you're buying insurance, that's not the end game of the cost. You can't just look at premiums. You have to look at the claims that you have incurred under the deductible. You have to look at how much you spend on loss control. You have to look at the administrative costs. You have to look at how much you're paying for the brokers and the outside resources to support the overall insurance program. So I had a background in that, along with being a CFO. Matter of fact, when I moved into taking over the role of Director of Global Risk Management at Moore Corporation, they were really heavy in calculating total cost of risk. So when ERM started to evolve, it was a natural measure that management already understood in a limited scale that could be easily expanded to look at it enterprise-wide. But that was a big challenge.
Okay. So the roots of this concept is coming from the insurance,
yes,
the cost of premiums and so on, organizations were paying.
Yeah, and what they would do is they would take that total cost of risk number, take it as a percentage of revenue, and it would give a sense, depending on your organizational size, how well you're managing your insurable risks.
Okay.
So, and I think to this very day, you can go to the RIMS website, and they have what they call a benchmark survey that uses this concept. I found it ironic that here we are. I mean, we're moving on to 30 years. Am I right? Or 20 years? 20 years since I got started with ERM, and we still do not have, other than this patent, people benchmarking overall cost of risk on an enterprise scale. And it's very interesting to me that the direction we've gone in hasn't been to seek that out. So hopefully today we can get people familiar with this, and maybe that will change. And I'm looking forward to that. So why don't we dive into a definition? this is my definition because I have found over the years now that if you take this approach, I think it gets to be makes sense to people a little bit more about what we're getting at. But if you really break it down, we're talking about looking at, in aggregate, the entire organization. We're looking at net costs, and I say net costs. What I mean by that is that there could be benefits or opportunities gained, revenues earned, increases in margin that offset the negative side. So I know you're a big proponent of that, Manoj, of risk isn't just negative, there's upside as well. So we're trying to bring in that notion. It can be good or bad when we're talking about net costs. But what we're talking about, it doesn't matter whether it was intentionally incurred or unintentionally occurred, but we do know one thing, that that cost is incurred as a direct consequential result that risk existed. So because we have risk, therefore these costs will be incurred. And it's a big theme in how we think about the ARQ patent. So really, if you want to make it really simple, all net costs that exist or are incurred because risk exists. So it seems really big, and when people start thinking about that, they're like, well, we may have risk everywhere, right? Well, what the notion here is, we've got to challenge ourselves a little bit, and we'll break into that some more on how to challenge ourselves in our thinking. That we might have an organizational group that fundamentally manages risk for the organization, but in the practice of managing risk, they also can be enduring risk, right? I get that concept, but we need to try to give some separation as we're looking at the entity in the market and how the entity is competing in the market, and then the risks are being thrown out at us because of that environment in which they live, and also because of how they operate internally. So it's very much in alignment with how you think from an operational risk perspective. You just need to focus that attention a little bit. Does that make sense?
Sure. And on your previous slide, there was the element of intentional and unintentional. So just to use an example, that if we have, let's say, a financial crime team, if we have 5 or 6 people to manage the financial crime type risk, whether there's external fraud or internal fraud, then the salary we're paying to that financial crime team is the intentional cost of managing those external fraud, internal fraud type risk. And then the unintentional, maybe if there was a hurricane or earthquake, and then a lot of furniture, a lot of computers get damaged, then the cost of replacing the furniture, the building, the computer would be the unintentional cost, and both of those costs are being incurred because of some exposure to the risk for the organization.
That's correct. That's correct. And even going back to your cyber example, you can have the intention to have a cybersecurity team. That's intentional, but then a cyber attack actually happens and there's consequential damage. That would be unintentional. So same concept. Yep.
Okay.
That's good.
So you would think that intentional is more what the organization is doing proactively in terms of managing that risk, and then unintentional is all the surprises and the incidents and accidents which happen, where the organization then has to end up spending some cost.
Yes. Or you can even look at it this way. Back in my Moore days, they were a manufacturing organization, and they intentionally endured certain levels of errors and reruns and so forth in the manufacturing setup. And they had a certain level, an appetite that they were happy with, but it was intentional to go ahead and allow that to happen, as long as it stayed within control. So that's still intentional, but and not proactive to mitigate, but it is almost an intentional acceptance, so to speak. So,
Okay, that's a good start, yep.
All right, so another way of thinking about this, and I like to use this metaphorically in describing what this cost of risk idea is that, an organization gets impacted by risk, and risk lays its fingerprints on the organization. So it could be revenue, right? Changes and shifts in revenue often, more than not, are the result of either an opportunity or a negative effect of risk. You could take the same argument with cost. Okay? Things are being shifted and bantered about because of the risk environment we live in. You can go as far as cash flow. Same thing. So what we're doing here, if we can think about this from a fingerprints perspective, is we're saying we have all these metrics, all have fingerprints. What we need to do, our goal right now, is to find those fingerprints, try to gather them all up, and get a good measure for them. This should tell us our risk management health, because if that number is greater than we want it to be, then we've got to find improvement.
Okay.
Because it's going to affect pricing, it's affecting everything. And what's interesting is that this is often overlooked by management. They don't think of it this way. They don't usually think of risk management as a way to help them compete. They think of risk management as something they must comply with to keep regulators off their back. So for us in the risk management field, by getting good at this, it certainly gives us an opportunity to excel in our organizations.
Okay.
Okay? All right, so this is, you get down to the basics, and I'll repeat this theme a little bit. I have yet to find another way. Manoj, I know you're one of the smartest men I've ever met. If you could come up with a fourth way that risk creates cost, I will humbly accept it. But I have melted it down into three ways. The first is obvious. We take action to manage risk. So we are putting in treatments. We are coming up with risk response strategies. We're trying to mitigate. We will spend costs to eliminate a risk. I like to think about the security fence around the plant, right? These things are being spent all the time. All the way down to the auditors like to talk about controls. Well, there's a cost to controls a lot of times. Yep. Whether it means slow down or extra time to deliver or what have you to assure that there's lower error, lower incidents. There's a cost to all of this. So this is the leading element that we can most easily find if we know what we're doing. And the ARQ patent goes through a methodology to really tease this out in an easy and repeatable way. So then the second thing is that we do experience losses. Their incidents occur. So this is sort of the consequential side of things. And bad things happen, so to speak, or the bumper sticker. So, but we have things that will occur that we can capture as well, and we'll get into ways that can be done as we get through the methodology. And then lastly, performance is affected. So if we believe that risk has no effect on performance, we're being very naive. Every organization establishes goals for themselves, and they go into any fiscal year attempting to achieve or overachieve on that goal. And any variance from that success is an indication that risk affected the organization. And we need to find a way that can be accurately and consistently applied to pull in that information in our calculation. So that is probably the most difficult thing that needed to be figured out, and probably why the patent was accepted, is to tie in that third element.
So if you take an example, Gary, then let's say a risk of theft of customer data by external hackers. So in the first bucket, you'll have then cost of all the controls you have around preventing the theft of customer data. So your firewall detecting suspicious activity, your IT security team. So the cost of all of that will go into that first category. If the theft of customer data does happen, and then we have to end up paying compensation to our customers, we have to end up paying some regulatory fine, then all that will go in that second bucket. And then as a result of that theft of customer data, if it becomes a big reputational issue for the organization and our customers lose trust in us, where existing customers may leave us, or we may also see a drop that new customers do not want to come to us because they think we will not be able to protect their data, then you would see the impact of that same risk on the revenue going down, and then it may also affect the profitability and return on asset and lots of other factors. Is that example sort of cover those three buckets?
One of the best examples I've heard. using one type of a risk that we might face and laying it out in all three categories. That was very well done, because that is and it's not just with cyber. I mean, if you really think it through, any form of risk that we have in the organization can have the same three effects.
Sure.
And the trick here is to figure out how to consistently tease it out, so that we can measure this on a repeatable basis and start gleaning some trend, some ways to have comparisons that give us that important feedback that we can put into the prospective aspect of risk assessment and risk management strategy. So, you see how this is starting to play is that it's almost like a profit and loss statement for general business profit center leaders and managers that are driving towards that profit and loss statement and also being compensated. We can now claim that we have our own financial statement in the risk management world that captures how risk is affecting us enterprise-wide, and then we can actually be seeing how well we're doing over time using these kinds of measures, because the reason why it's called aggregate risk quantification, we can aggregate this to the whole enterprise level. It can be rolled up. Okay. So it's I think a very, for me, it's been an exciting thing to be working with all these years, but it's that simple as you just laid it out. So let's take it to another step, because you've got to think about this. We've got three ways, right? But really, there's two sides of the coin, so to speak, Manoj. So the one side you brought out very well, the treatment, the controls we put in place to manage that cyber risk. That's pretty easy to understand, right? That's what we intentionally have done. But you also described very well the consequential side, that we had some fines, we had some losses to pay to customers, and then we also got impacted by performance. And that was the consequence of this thing.
Right.
So now think about this. When we're doing risk assessment now, if we could understand that consequence side, isn't that what we're trying to peg when we're doing our risk assessment? To identify risk and to understand the consequences? Isn't that what we're trying to get to? So that we can, if we understand cause and we can manage it, we know exactly how well we can affect the organization. And you talked about my zeal for quantification. You can see why, knowing where I've gone with ARQ here, why I love quantitative risk assessment, because it's the other side of the coin, to bring that in the long run. So anyway, the two sides are very important. Is there any question regarding that before I move on?
No, I think we covered that. Yeah, so this is a different view of the same information we had. So yeah, no questions and no questions here.
Okay, so what does it really measure then? So let's think about it, right? If we talked about it being net cost, right? So it can be good and bad. It doesn't matter. But really, it's a trade-off, right? We're trying to figure out how the business has been making trade-off decisions between doing nothing or doing a limited amount of something versus rolling the dice and seeing if the consequence will occur. And your example was a great one. How much cybersecurity do I want to spend money on versus how much consequence I think is going to come? So we talked about just a second ago the risk assessment side. If I don't have a good risk assessment program in place, how would I know how to make that decision?
True.
But I can tell you with ARQ, I can tell you if you're good at it or not. Because if you're good at it, then you're going to be very optimized in that trade-off decision that you're making. And the cost of risk is going to calculate it for me. Secondly, there's a real relationship that is going to be drawn here between performance and the risk the company takes and the actions, right? We suddenly now are creating a financial link. Hallelujah, right? We're now speaking the language of the C-suite, which we all struggle with. This gives us a way to bring it to them. And then lastly, we can bring to them a measure for what risk management is doing and show them over time whether we're doing well or whether we're doing poorly. Not that it's our work, because we know that in risk management, we don't own risk. Management owns risk. But we can certainly report to management how well they're doing in managing risk over time.
And in the cost here, the trade-off, it includes the cost of business as well as the cost of risk? Or are we only referring to the cost of risk on this?
I'm looking at the cost of risk.
Cost of risk only, okay.
Right.
Okay.
So is there trade-off, right? So how much of my business's cost of risk is really going to be related to how much risk I'm willing to take, and then ultimately we're trying to balance that against optimal performance.
Yeah.
So that's really what's going on here.
Yeah. And then the one scenario sort of we can relate to that is, so let's say if I'm a insurance company, insurance company, and then I have a direct sales force right now to sell insurance, and now I have a decision where I could go and work with financial intermediaries who could then also sell insurance to their clients who come to them for advice. And in that case, the performance may be that if we go with that channel, we may be able to increase our sales by, let's say, 25% over the sales we're making today. But then going with that option will also introduce additional risks for our organization, because now we would have little control over whether these financial intermediaries are mis-selling the insurance products to the client, and because they're selling our insurance product, we would still be responsible. That if an incident happens and it gets reported in the media, yes, the financial intermediary will bear the negative impact, but the organization, will bear a higher negative impact, and that's where, as an organization, you may be making this trade-off decision, saying, okay, do we want this extra 25% revenue? But with that extra 25% revenue, we are increasing our risk exposure for certain risks, or maybe we are introducing new risks in our risk profile, which we may not have exposure to today. And then the business is always making, those sort of trade-off decisions. It's just how much information you have when you're making that decision, I think, is what we are arguing about here. That it's not that they're not making these decisions.
Yeah, they're making them, and they're making financial decisions to try to mitigate, but they don't really think of it as being part of the risk management function per se.
Right.
And so what we're doing here is we're forcing them to start, we're confronting them with their own financial decision-making and connecting them back to that they are risk managers. And that they're making these decisions from a risk management perspective. So then the question is, how well are you doing? And if they're not doing as well, then it kind of gives us in the risk management world a quantifiable reason why they need us and why they need us to help them with this decision-making process. Yep, that's exactly what it is.
Great. And I think in the operational risk space, Gary, there's another sort of struggle I have seen most organizations talk about is the second line, so the op risk function. It is really difficult for them to get the ownership about the risks from the first line. That it's really difficult to get first line to do the risk assessments, to capture the incidents.
Right.
And I think personally that one of the reasons is because this connection is not there between what the first line is trying to do, because the first line is trying to increase revenue, get more customers, increase profit, and then if we somehow are able to show that, hey, the risk is an integral part of what you're doing, then maybe they'll be more open to integrate and talk about risks, rather than this other approach where risk is always this separate topic, in a way you run your business and then once every year you stop and then do your risk assessment, make your second line happy, and then you go back and run your business. That I think this may help sort of connect that you are making these decisions anyway. If you look at risk in a little bit more structured way, and that's where the second line risk function can help them with that. I think it'll address that ownership accountability issue around risk management.
And that's a great segue into this slide, because if you look to the left, the traditional view, I'm trying to give it from the C-suite guy, right, the profit center leader. And they're looking at their business and they're saying, look, I've got to drive revenue, I've got a cost to deliver that the services I need to deliver to generate that revenue. It's going to give me a margin, and of course there is general administrative costs that go along with that before I can get to the profits that I contribute to my organization, right? So we can look at that from a business unit perspective. So that's their traditional view, but they're just seeing it more holistically, and they're focusing all their energy on these big numbers, gross margin, EBITDA, earnings. And then they often, when things aren't working right, we cut costs across the board, right? They think that all cost is the same. And what I'm going to show you is that that's not the case. All cost is not the same. And when cost of risk emerges, it's a different animal. And in many regards, it's not bad cost, it's essential cost.
Yep.
And we'll get into that theme a little bit. So to the right, applying what we did on the previous couple screens, we're going to find cost of revenue in the revenue accounts of the organization, right from their trial balance general ledger. We can find it. We're going to, and this is the old CFO in me that brought this out, Manoj, but it's there. Within the cost of services, it's there. So therefore, when I get to that first step margin, managers need to understand, yeah, there's overall margin, but there's also a margin I would have earned if risk wasn't there. Going back to the beginning of our presentation.
Right.
If risk didn't exist, right, I would have made a lot more money. But because risk exists, I am forced to spend to manage that uncertainty.
Mm-hmm.
Now, the question is, how good am I at it, right? That's the question. And it drives G&A and earnings.
Yep. So, Gary, before we go ahead of the gross margin, so I just want to understand, so cost of service sold, so if I'm an insurance company, let's say, and we sell insurance through our website, so I need to have a website where customers can come, they can get a quote, and if they like the quote, they'll buy the insurance product from our website. So the
Correct.
cost of maintaining and running that website is the cost of core business, because I
well,
need
you
that.
use the word that I would be cautioned on. You use the word maintaining, okay? So the cost of having that website is certainly the cost of services. But if I need to maintain that, suddenly I have an operational risk, right?
Okay.
So I have to sustain that website. That the risk to sustaining that website would be my maintenance, right?
Okay. But so the cost of developing that website, so let's say if I have to spend $500,000 on building that website, then that $500,000 will be the cost of the core business.
Correct.
In that box.
Yes.
But now I know that when I have a website on the internet, it may be hacked by hackers. So I'm exposed to that risk that as soon as I make the decision to have a website, I also expose my organization to that risk. So now the cost I need to incur to protect my website from the hackers, so if I have to put firewalls, if I have to, sort of regularly patch any vulnerabilities in that software, so all that cost will be the cost of risk.
Yes.
In that bucket. Okay.
Correct.
Okay. So we are separating that there's something our organization is spending just because we have to go and get the revenues, and then there are some costs where we're spending because we are exposed to the risk. If we were not exposed to that risk, then that would be the saving we would have for the business.
Right.
But can you help me with the similar example on the revenue side? So how would that help? I'm trying to think what would be a cost of risk on the revenue side.
From a banking perspective, I'm probably not as familiar as you would be. I mean, the one that I have seen out there is I've worked with a few brand-rich companies that are in like the clothing business, right? And they'll get things up there like they may have returns that come back. So it's almost like the incident costs of stocking inventory in their distributors.
Okay.
So like Walmart didn't sell 20% of the T-shirts that they had on the shelves, and they sent them back. So they have to return those back to inventory, and they write them off.
Okay.
That becomes a cost of risk. So and that's just how they book it in their general ledger. It's like a negative revenue.
Okay.
How about discounts? There's a good one. If I'm in my financial structure, I may show my revenue using gross pricing, okay? But then I also book the discount that I gave a customer as a reduction to revenue in the revenue category, so that when it's reported, it's a net revenue number.
Okay.
So that is a cost of risk, right? I chose to give discounts to try to drive revenue. You see?
Right. Okay. So I think in financial services, probably in the UK, it may tie similar. I don't know whether it's exactly the same in the financial books behind the scene. But when you go and buy an insurance policy, you get 14 days basically in UK when you can cancel the policy. So you have that privilege, as a customer. So of course, if the organization books that revenue and within the 14 days somebody says, okay, I don't want this insurance policy anymore for whatever reason, then of course the organization has lost that revenue.
Yeah, that's it. Yeah.
That's good.
So going back to our 3 ways risk creates cost, that would be one of those incidents, right? So it's not a cost to manage, it's an incident.
Right.
And we would bring it into that category.
Okay.
Yeah.
Okay, and then because there is the cost of risk on the revenue and the cost side, so that's where on the gross margin, now if you were not exposed to the risk, your gross margins would have been a lot higher. But because you are exposed to the risk, now some of the gross margin is your pure business margin, and then that is reduced by the money you had to spend on managing the risks around the revenue and the risks around the cost.
Yep, the managing and incurring the incidents. Yeah, that's right. So that you're following along. So that's why we can do this. And what we'll show you in ARQ is that ARQ gives you the methodology to very systematically tease these costs out of every level within the organization. And when we originally validated this, the University of Virginia at Darden School, the guy was amazed. He said that this has been staring at us all along. We just never looked at it.
Right.
And it's right here. So yes, that's exactly what we're doing. But like you said, though, we can carry through your logic through the whole P&L.
Yeah.
So we can look at administrative costs the same way. We can say, well, wait a minute, I've got my security team that I keep in my administrative costs.
Yep.
That security team's cost of risk. But on the other hand, the executive team, maybe the accounting department and so forth, will put in the core business.
Yep.
And then we might debate about human resources. We might say human resources really is managing the risk to having people. And we'll put them in the cost of risk. So you start getting into this, and from a risk manager's perspective as a professional, okay, it's a rewarding type of assessment to go through and sit down with the client and have them confront the general ledger and understand how they're incurring costs on a risk level. And it's very revealing to them because it starts to almost like a mirror. It's showing them how they've thought of decisions in the past.
Yeah. So in the general and admin, then an example would be that if we are hiring lots of employees, so of course we need the HR department, we need some systems in our HR department for that hiring process. So the cost around those processes, those systems would be core business, but then we may have to buy some database, or we may have to buy some external service where we want to do reference check. We want to make sure that the people we are going to hire, they're not criminals or terrorists or fraudsters. So we may hire an external service who will then cross-check or do those reference checks for us. So that would go into the cost of risk around the general and admin. And then if you have to give employees, let's say, a whistle hotline so that they can report anything illegal or inappropriate which may be going on in the organization, then the cost of running that whistleblowing hotline could also be the cost of risk in that general and admin category.
And you're looking at it sort of through the lens of today's work environment, right? I worked with a client one time that was in business for like 60 years. And one of the gentlemen who are still part of the business, an older gentleman, he looked at HR as being 100% cost of risk. And I said, really? And the reason why, he said, when we got started, we didn't have any HR people. That's what managers are for.
Yeah.
Okay? So think about it from his logic. His logic was, as the business grew, as regulation began to dictate, he needed professionals to manage the human resources risk of his business. Yeah. So therefore, the HR department was born. That's how he viewed it. So what's the beauty of this? That company looks at it that way, but the company you described may look at it the way you looked at it.
Sure.
Everyone needs to come up with the way they want to view their cost of risk, but stick with it. Whatever it is, stay consistent. Yes.
Yeah. Perfect.
Okay.
And then all that flows into your final earnings, which is your final profits. And again, if you didn't have those risks, then your profits would be higher, but because you had to spend money on managing those risks. So this E-Core is a concept which is part of your patent, or is that a generic?
It's part of the patent. It's part of the patent, and we actually have the enterprise total cost of risk, and then we have an enterprise cost of risk. So the difference between the two is that, remember back to our 3 ways that risk creates cost?
Yep.
The third way was performance, right? So if you have a variance that is negative or positive, doesn't matter, that variance is added to the overall E-Core number to get to your final net number, which is the enterprise total cost of risk. So if we want to look at it just what the general ledger says, not looking at any performance variability, then we'll call that E-Core. If we start weaving in that performance piece, we call it Et-Core. Okay?
Sure. And I just want to correct myself. Gary, I noticed that I was making this traditional mistake where I was saying, if we didn't have the cost of risk, then our profits would be higher. Of course, that's not 100% true, because if you have exposure to risk and then you don't spend on the controls, on managing that risk, then of course you may have an incident where you may end up paying 10 times more.
Or you just don't get the revenue. You never get the revenue. Going back to that performance side that you brought up earlier, that cyber example where you had a reputational risk. So that you're getting it. You're getting it. So to say it's just pure cost is wrong, because that loss, that cost of risk is assuring that revenue will be consistent within your appetite. And if you don't have it, it's the Wild West. You don't know what's going to happen, right?
True.
You don't know what's happening. And that's why I like that whole notion of trade-off, right?
Yes, that's what I was going to say, that, it's that trade-off, right? We're not saying we're not going to spend on risk management because our profits go down due to that. So we just have to be smart about and know where we are spending.
Once again, you're the master of transitions. So you're leading right into this idea, right? Revenue is what the organization is driving towards, and it's, revenue must cover all costs, right? That's what we're trying to do. If we don't, we're making a loss. So if we're looking at the cost of doing business, it's everything, right? But we've made all these trade-off decisions to either incur cost on a risk side or to invest our expenditures to try to drive business. And we've got to do one or the other, and one is not more important than the other. And I often think that the cost of risk is more important. I was speaking before the U.S. Census Bureau, and one of the people on the floor were asking questions about how we derive the cost of risk, and started getting into, my organization is not risk, we are essential, so forth and so on. And at that time, my nephew was in the United States Marine Corps and was in Iraq. And he was part of a security team, and I got to thinking about my nephew being out there managing the perimeter around a base to make sure that everybody inside that base was safe. And I thought to myself, are you telling me that guy is not important, right, and that he's not essential? I think everyone inside who felt they could sleep that night because that guy was on the outside would think differently. It's all a matter of how you want to view this, and we're incurring these costs. We're investing in management of risk, and we're trying to keep our incidents and consequences within a level we're comfortable with, but it's essential to how we run our business. And so then when we go back on the core business side, we have the cost of all the key functions to deliver our mission, right, what we do for a living. And you can think of it as this way. Those functions are what technically are at risk, right? We put those functions at risk. So in the patent, we call them risk producers because they're at risk. And then lastly, we do have capital expenditure, and it's the infrastructure and so forth of the company that's essential to deliver. And I think you gave some great examples, like the internet, or we're going to be doing internet sales, right? Those costs are going to be incurred. So to kind of capstone this whole discussion of what is cost of risk, we got to remember that all risks are important to driving towards the end game. But when we talk about cost of risk, in many regards, you start cutting that, then all of a sudden that red box down there starts to get a little volatile and more volatile. And that means that profits could be significantly hurt over time if you think you can just cut these costs across the board.
Sure.
And I think this is something a lot of managers need to know.
Yeah, and that's a good slide, because it sort of integrates the concept where risk management is not something on the side. It's core part of the business.
Absolutely.
So I think it brings.
I know that you had mentioned to me, and I think the next slide is yours, Manoj, of how you think of this from an operational risk perspective. So, maybe you can give me some idea of how you view it, and that would be great.
Sure. So I think it's basically taking your ideas, but translating it where on my training courses, I try to sort of create awareness around this topic. So where we start with the profit, so that as an organization, that's where we're all trying to be profitable organizations. So profit is driven from revenue and cost, and that those are the two inputs. So we're looking at cost today. So if you look at cost, then we talked about earlier the cost of business and the cost of risk management. And then from an operational risk perspective, that if we were doing this, then you would divide, say, okay, we have one bucket where we have cost of credit risk management, market risk management, so all that goes in one bucket, and then the cost of operational risk management can go in one bucket, which we can then further divide into the cost of control. So we have a few thousand controls in our organizations. We have implemented to manage the operational risk, so that goes into the cost of control bucket, which can then be made up of people. So we have people-based controls, where we have IT security experts, for example, who understand how to manage that particular risk. So all the cost we are incurring on having those experts are the people cost around the controls. We have processes in place, so we have due diligence on new customers, we have due diligence on new vendors, background check on employees. So we have all those processes which are in form of controls to manage certain risks. So the cost of those processes would go into that bucket. And then we have systems to manage the various risks. So we have firewalls, we have suspicious transaction detecting systems, credit card fraud detection systems. So all that would go into that bucket. And then there would be a cost of creating that, communicating the awareness around the controls, that we may have to do e-learning courses around anti-bribery policy, ethics policy. So the cost around creating that awareness around the controls can go into one bucket. So all that then can tell you that, okay, as an organization, we're spending, let's say, $50 million, on the cost of controls around operational risk, depending on a size of an organization. So that becomes your proactive bucket, that we are spending all that money proactively because we're exposed to various risks, and we've decided that these are the areas where we should spend money in order to manage the risk. And then the second bucket is the cost of incidents. So these are your expected and unexpected. So if I'm a credit card company, then I know that there will be a certain amount of credit card fraud my organization would be exposed to. So it's an incident, but it's an expected cost. So it could be those sort of incidents, or it could be the unexpected incidents, like a natural disaster or a terrorist strike or a cyber attack. And as part of that bucket, then I will have the direct cost around those incidents. I'll have the indirect cost around those incidents, and then the recovery cost of sort of bringing my systems back online, bringing the organization back into operations could go into that other bucket. And then there is this influence that the less money we spend on the cost of controls may increase the size of the incidents, going forward, that you may not immediately see those incidents, but that, as soon as you start cutting down on the controls, you will see the cost emerge on the other side of your general ledger in form of incidents, and generally it'll always be in multiple times higher than what you would have spent if you had proactively decided to manage that. And then on the left-hand side, I connect the cost of controls directly to profit, because this is where senior executives, could sort of manipulate the financials, where they could, if they would have to show a higher profit, to the analyst and to the shareholders, then one easy target is to go and reduce those cost of controls, because they may not have a short-term influence or impact over that incident. So they may go and say, okay, let's not spend money on that IT security system, or let's reduce that due diligence there, and that may increase the profits in the short term, and that's where, if I was a board member, I would want to know whether the profits of my organization, are they really increasing because our business is doing better, or the profits are only increasing because we're cutting down on the cost of control, which is not a good way of making profit, because I know that 3 years, 4 years, 5 years down the line, those profits are going to disappear because I'm going to see those bigger incidents come in. So that dynamic between risk management and profit is where, then in some organizations, senior executives can sort of exploit that, where if they want to show higher profit, they'll go and cut the cost of control, and then, of course, the compensation and bonus and all that is tied around that profit figure. So that is sort of my way of taking your ideas but translating this into a little bit into the operational risk management space. And then I have
those. It's a good way to do it. It's a good way to do it because you're really keeping to the same concept of the trade-offs. You're staying with the same concept of the 3 ways risk creates cost. You're just dissecting it categorically along operational risk lines. I think it's a very effective way to do it.
Yeah, and then I typically on my course I ask those questions. We have on the right-hand side. So, what percentage of your organization's overall cost would you think is cost of risk management? And let me see. Let's pose that for the audience we have here today. So before I share the numbers I get from on my training courses, is there anybody who wants to share? So you can use the chat functionality. And tell us if we know that it won't be precise, but just as at a very high level estimate, that if your organization was spending 10 million on the total cost, how much of that 10 million may be cost of risk management? So let's give 30 seconds and see if anybody wants to share. We know it's a rough sort of it's a guesstimate, right?
I'm very curious to see what we get here.
Yeah, I don't think we have any takers today. Okay, I will just give 20 more seconds and see if anybody is calculating on Excel spreadsheets.
Pulling out their what was the old Hewlett-Packard calculators.
Calculator, yeah. Okay, I don't think we have any takers today. So the general number I get on the training courses is 60%. For that first question.
Wow.
That out of every £100 the organization is spending, £60 is going in terms of all the cost of credit risk management, liquidity risk management, market risk management, and operational risk management. So it's all the cost, right? That first question is about all the cost of all the type of risk an organization is managing. And then when I ask the second question, so what percentage of your organization's overall cost is the cost of operational risk management, then that would be in sort of 20 to 25% range. So almost half of the cost of risk management, is for operational risk space, just because it is so wide that it touches every process, it touches every body, it touches every system
right.
in the organization. And then for the last question, I haven't got any answers. So on my training course, I don't think any organization has done that level of analysis where they were comfortable, even giving a guess around the last question.
Right.
But is that tie in with what you have seen in other industries?
Well, yeah, I have worked with an insurance company who included in their enterprise total cost of risk the direct underwriting side of the equation. So they would include, for instance, losses that were incurred that they had to pay in their total cost of risk. When you do that, then you're getting what numbers they have are getting north to like 50%. So in your question, when you're talking to financial services organizations, they're probably thinking, well, we're in the business of managing risk, so a lot of our cost is tied up in delivering that service.
Yeah.
So it's, again, how you want to do it is up to each organization. They might say, well, no, I don't really want to look at what we do for a living. That's our mission. Let's look at all the other cost of risk. If you look at it from that perspective, we have seen it range from 20 to 40%, depending on the industry. I have yet to see anybody less than 20%, and I think that's really the number we should focus on, Manoj, because we're talking about some pretty big organizations. If you're saying 20% of their revenue is cost of risk, that's a big number.
Yeah.
That's a really big number, and they don't really understand it because they don't look at it through the lens of risk. It's just not what they do. Yeah.
So I think at least in this question, the benchmark was the total cost rather than the total revenue.
Right.
But it is sort of a little surprising that if organizations think that 50-60% of their overall cost of the whole business is around cost of risk management, why are more organizations not doing something to try and get a little bit more clarity, a little bit more detail on that bucket? And that's where I think the risk and the finance team, could sort of come together to create that view, because you'll need support from the finance organization, to get a little bit more understanding around these numbers we're talking about.
Why don't we transition our discussion? I can use, just for people's information, if they want to know more about the aggregate risk quantification patent. This slide gives you the U.S. patent number. There's actually a link at the bottom here where you can go and learn more about it. I created this slide to bring in exactly what the U.S. Patent and Trade Office documents and supplies to the public. So this is what's out there. And then what we can maybe get into now is the methodology. Okay, so we now know what cost of risk is, right? I think we all can agree it exists. We're familiar with how it works. Now let's get into a methodology of how we can tease it out of the organization. And after that, we can start getting into some more real-life examples of outputs.
Yeah. And what was the date of this patent, Gary?
It was in 2010, and I'm going to say, I've forgotten the exact date, but I think it was like in October of 2010 is when it was finally issued.
Okay.
Yeah.
Okay. So then let's
that date, right?
an anniversary.
Yeah.
Okay. Perfect. So let's then look into the details of. So we understand the concept that why understanding that cost of risk is important, but now we need some tools, some thinking to get to those numbers. So
let's do that. So now we gotta. I know a lot of our folks are not that good with general ledger data. They're not accountants and so forth, and so in many regards, they're going to have to trust me on how the general ledger is normally structured. But I'm going to try to make it as simple as I can. I'm going to use an analogy of buckets. Okay, we're going to be using buckets to kind of go through the logic. So if we can think of it this way, the main bucket that the general ledger tracks is all revenues coming in the door and all the cost of doing business, CODB, going out the door. Okay, so that's one big bucket that is being captured in the trial balance. That's what we're looking at. So our goal with deciphering the cost of risk is just like decoding some kind of secret message, right? They're encoding the general ledger using a methodology for a different purpose, right? They're trying to get to earnings. Well, we need to take that code and decode it a little bit, decipher it to figure out what is cost of risk.
Okay.
And that's what we're doing here. Okay?
Okay. So the primary source then, Gary, for all the information based around the methodology in your patent is in the general ledger. So we're not doing any qualitative assessment here. We are going and getting the actual numbers the organization has spent.
So every financial close, and then we can use budget data as well, because the budget data is going to help us to understand financial goals, and that way we can get to the performance number we were talking about, that third element. Yeah.
And would the budget data also be typically in the general ledger? I'm not that familiar with
they often will have a separate budget system that uses the same account structure.
Okay.
So within our system, the ARQ technology system, we set it up so you can literally have a decipher for actuals, but use that methodology and have a sister decipher for budget so that they are consistent, apples to apples.
Okay.
In reporting, yeah.
Okay, so there's an element of actual cost the organization has spent, let's say, on cyber risk controls, which you'll get from the general ledger, but then the budget is the more forward-looking, so you know that, okay, in the next 12 months, we're going to spend this much on managing our cyber risk.
Yes, and if there is some kind of variability there, then we're all automatically catching a performance problem, or even exposing an incident. So what I love about this methodology is that you may not have the exact number, but you can back in the fact that something's there, and then you can go investigate. So if in those organizations that are struggling to get people to report incidents and to do loss reporting, this methodology automatically exposes when it occurs. And now you just go where it happens and get the data out, and you can find it. Okay. All right. So we got to think logically here. So if we go from the top down, okay, we've got this full bucket, revenue and cost of doing business. What we want to do is we want to dump that cost and revenue accounts into two new buckets. So we want to drop some of the cost into this bucket I'm calling dedicated cost of risk, and then we'll keep all the rest, we'll keep it flowing into a bucket we're going to start calling cost of core business, okay? And yes, there is revenue accounts in there, so, okay, you got to work with me. I'm trying to make it simple, okay? So at the end of the day, you're going to have these two buckets. Now let's talk about what is dedicated cost of risk. We talked about it earlier. Organizations like that business that was around for 60 years, they looked at the human resources department itself as being a cost of risk, because in their mind, he has invested in the management of the human resources risks of the company. Right. So we call that, when you allocate people to addressing risk, we call that dedicated. Does that make sense?
Yeah.
So we're dedicating people to manage risk. Now, you could have a partial person dedicated to the cost of risk. I get that. And in the ARQ technology system, we allow for that. So you could say, well, wait a minute, Gary, Bob over there, half of his job is really core business related, and the other half is risk management. Exactly. But you need to understand that people are allocated to manage risk, their time, either totally or in partial. So once we understand that, that's a big chunk of cost, right? Because often organizations, when you look at their account codes, they'll have what are called responsibility centers or department codes, right? If we know a department is job 100% is to manage risk, we've just grabbed a whole swath of cost and pulled it into our cost of risk bucket very quickly. So that's the key here, right? We want to get big chunks of cost first before we get into the smaller chunks of cost. Yep. That makes it easier to decipher.
Yeah. And then when you're saying it sort of goes into the bucket, what we're really doing is we're going through the general ledger sort of cost center by cost center and saying, okay, this cost center is cost of core business, this cost center is dedicated cost of risk. So we're doing some sort of mapping to the cost center codes within the general ledger.
Correct. And actually, to do it right, you should, however the general ledger is set up, you may have entity levels, you have regions, you have the department levels, and then eventually gets down to an account code. So you're going through the various aggregation steps within the general ledger structure, and you're making decisions. Okay?
Okay, and this is a one-time exercise, right? Because you only have to do that classification once, unless you're adding more cost centers in the future.
Well, if you're doing it manually, often this becomes a very laborious process. So if you have the system like we have, it can be done in hours and it's repeatable. But what you do, you have to go through that process, and then once you've made that first step, then you have to look at the account codes themselves. So now we're looking at these department codes and so forth. Now we're looking at the account codes. So we're going to look at those two buckets with a new lens.
Okay.
And the goal is that we're going to start pulling things out, right? So we're going to be taking from the dedicated cost of risk whatever we can find and putting it into three new buckets, and then we're going to look at the cost of core business. We're going to get anything that's revenue, move it into revenue bucket, and then we're going to try to look at both of those buckets and see which of within those buckets belong into discrete risk financing and monitoring as well. So those three new buckets are discrete cost of risk. So think about it this way. If you're working in a bank and at the teller's station, they put down, I'm going to make it really simple, they put down rubber mats to protect the back of the teller.
Yeah.
That's a cost of a discrete cost of risk.
Okay.
If you then look at risk finance costs, that could be insurance premiums, maybe reinsurance premiums in an insurance company,
Yeah.
right, that are being paid for. And then monitored risks are where we have an account code that is actually tracking incidents. So earlier I discussed the manufacturing side of things, where we might be tracking errors or reruns or costs in the production line. There are account codes to do that, and that's the monitor risks bucket. Okay, so we will find those costs sometimes in the dedicated cost of risk bucket, but most likely we're still looking over at the cost of core business and revenue buckets that remain. So in this whole process, sort of there's a reshuffle again that's happening. And once we get them all into the right buckets, at the end of the day, we have what we know is now cost of risk. Yep. And then on the other side, because we've got cost of core business and revenue, we actually have an earnings before cost of risk number over there.
Yep. Okay. Yes. Yeah. And we have a good question here, Gary, from Brian, where he's saying that over time the cost of risk may evolve into cost of doing business. So how do we get the consistency across the firms and sectors? So I think that first point I think is a really interesting one, where in HR, for example, where we do background checks around our employees. If you go and talk to HR and you tell them, okay, the background check you're doing is actually a control, they may say, no, it's not a control. It's just part of my job. Where it may be difficult to know that, okay, is that really a cost of risk, or do we put that as the cost of doing business? What's your take? Have you seen sort of examples around that?
Well,
you talked about the HR example.
I think it gets down to management's decision, right? So if management used to think that human resources was the cost of risk, and then new management comes in and says, no, it's not, only part of it is, then it's almost like when you make an acquisition as a company, you're going to have to restate your financials, right? So if you're making a Decipher change, and now you're saying, no, human resources is the cost of core business, you have to restate all the previous periods using that Decipher methodology. But you can still have a trend. And Brian, I don't know if you're willing to give another note, but if that answered your question, if not, if you can give me an example of what you're thinking about, and maybe I can answer it a little bit more precisely.
Yeah, and I think his second part was around, how do you get consistency across firms and sector? And I don't think that's the intention here, right? Because this is very specific to an organization. So if, let's say Barclays, just as an example, if they were doing this, then somebody in Barclays is deciding that, okay, in Barclays, this is cost of risk, and this is what we'll consider as cost of the core business. But in HSBC, they may make a slightly different decision. So the decision on what is the cost of risk and cost of business is really how that organization looks at that cost center. But
Ryan is right, though. If an industry group or a sector gets together and really starts to adopt this cost of risk view, then they might start establishing standards, right? Standards around what is in cost of risk, what is in the cost of core business. Right now, the way we have structured it, Manoj, is to be a principles-based decision. So this Decipher is based on how management views the simple question, would this cost exist if risk didn't exist? And you start making that decision. And we have 20 principles that we use that are proprietary to assure that once the decision's made, it's maintained consistently, over time. But I think Brian is right. You never know. 10 years later, there's a new management team, and they say, I disagree. So then you'll have to restate those previous years.
So at least then, if within, let's say, there's a group organization, and under that group there are lots of, the group owns a lot of organization, and at the group level they wanted consistency, then they may have to enforce, some standard across all the organizations, so that when those numbers get aggregated at the group level, the methodology is, if it's consistent, the numbers will make sense at the group level.
Correct.
Okay. Good question, Brian. And we are in our last 15 minutes, so this is a good time, for you to, if there are additional questions you want to pose. Okay.
Maybe this will stimulate.
Oh, so this was an example slide. Yeah. Okay. Yeah, so this is another slide I cover, Gary, from the course where I want to sort of translate the concepts we're covering today from an operational risk perspective. So if we were doing this, if we implemented this methodology, then one of the output we could get, is a report like the one displayed here, where on the left-hand side you have all the operational risk categories. On the columns you have the cost of risk around the people for operational risk, and then once you've done the mapping of your general ledger code to the relevant buckets, then you can get you can sort of refresh the numbers from your general ledger and get a quarterly view, or get a monthly view, or a semi-annual view. And then you can sort of track over a period of time, are you spending more or less money on managing a particular operational risk category? So in this case, in the people side, we can see that in the third-party risk is where the cost of the controls we have around the people-related risk have gone down by 40%. And then that may spark some conversation internally, saying, hey, what is going on there? Why is there such a big reduction in the controls or people-related controls we have around that particular risk? Similarly, in the process category, we have for third-party risk, where we have increased the process-based controls by 50%. And again, that's looks like a big jump from one quarter to another.
Right.
So again, that may spark that conversation.
This is a great example in the ARQ system. The standard table, we call it a risk table, okay, and it does exactly what you've done. The standard is just to do it by risk categories, but what you've done is added another way to dissect each risk category by doing it by people, process, systems, and communicate. And this is excellent, because you think about what you've done here, you can now look at trend over time.
Yeah.
And you can look at seasonality. And you could start tracking how things work within the dynamic of a business. And it's very effective. You really get some red flags that fly up when you look at it this way.
And then you can also compare this with your risk assessments. So if we have, for example, on external theft and fraud, now we know we have spent, let's say 2.3 million, in quarter 2 and 3.6 million in quarter 1. So we've spent a certain amount of money, and how does that tie with the risk exposure? So if we have the financial impact from our RCSA, we can then sort of compare, saying, okay, the potential financial exposure we have around that risk is 60 million, and then we've spent 6 million, in the first 2 quarters to manage that particular risk. Then you can see whether you are spending more money in certain risk category where maybe the exposure is lower than the amount of money you may be spending on managing that particular risk. That you can tie this cost information, because this is the actual number the organization has spent, so there is no qualitative element here. But you can tie this with the risk assessment to then make that complete picture on, okay, are we spending the money in the right risk areas? Because if my risk assessment says that, okay, here are my top 5 risks, but my cost says that, okay, the top 5 risks where I'm actually spending money is different to my risk exposure, then that can trigger some conversation saying, hey, are we spending money on the wrong risks?
Right, exactly it. And this is where a lot of times we don't know this, right? Until you really get into the cost of risk calculation, we start realizing, wow, I got a major exposure, but we're hardly spending anything, and here we've got one that we really have comfort now in managing this risk, and it just seems like the cost of it's evolving and has a life of its own. And so now you can start looking at reallocating resources more appropriately to optimize within our risk appetite. So that's the concept. Yeah.
So I got one more question, Gary, from Armil. So I think we're going to touch that a little bit later. That how do we quantify the cost of controls in each risk category? So how do you say that, okay, this is the cost for managing money laundering risks, this is the cost for managing cyber risk? And
well, we can go back to this previous slide. So when I'm looking at the account codes, all the way down to the bottom within the organization, certain accounts are there to capture certain types of costs. So these controls costs usually are well identified. So when we start looking at the costs and what they're there for and what they're capturing, and understanding its purpose from the general ledger definitions, we can then make that decipher decision that, yeah, that's a cost of risk, and it's a discrete cost of risk, which is typically the controls bucket that we would put into there. Yep. So
and we are because we are in our last 10 minutes, so maybe we can jump to that screen for Armil where you do the allocation. Where we say that 70% of this cost is for external fraud.
Well, I guess we can answer the one question: why do we care, right?
Yeah.
And it really is the fact that exactly the question Arnold's bringing in. It's quantification. You start quantifying things, you're going to get clarity, and we can get into. You can provide the next few slides to the participants so they can get an idea of benefits. But that really where it's all melted down. It's all about quantification.
Sure.
So okay, let me get through all of these here. Okay. So I think you're thinking about.
Yeah, this was the one, which might help Armil.
So this is actually a decipher screen within the ARQ technology system. Okay. So in this particular case, we're looking at an account string. So if you look at the very top up here, you can see the first step of the account string was 3 digits. Yeah. Then there was a second step. There was 3 digits, and the third step. So we're actually all the way down to the third level, called the responsibility center, okay? And we're making a decision. So what we're saying is this account code cost of risk or is it cost to core business? And then if it is, why, right? Explain why you think it's cost of risk. Now what's interesting is we do allow for it to be a percentage. So if you can't say it's 100%, maybe 20% is. You can carve out a percent of that code and apply it to the cost of risk. But I think where you're going with it, Manoj, is the fact that we can also go further and begin to align it with what categories of risk we're looking at in the organization.
Yeah. So I think that's where you can get that answer that, okay, we are spending so much money on external, managing our external fraud risk. We're spending so much money on managing our internal fraud risk, and in this case, you've taken the cost of the financial crime team we have. So if we have 10 people, let's say in the financial crime risk management team, and they do all the investigations around external fraud, they do all the investigation around the internal fraud, then in this case, 70% of the salaries we are paying to the people in the financial crime risk team is being allocated to the external fraud risk, and 30% is being allocated to the internal fraud risk. And that's how, when you do that reporting, it'll split up whatever numbers come from the general ledger.
So what's the beauty of this is by having this methodology and automating it, first of all, it gives you a really quick way. Great example, when I worked with the Census Bureau, the first time I worked with them, I did this in Excel spreadsheets. We had not got the patent yet. We were waiting to get it done. We had software kind of in process at the time. It was a while back. It took 2 months to get it done. So once the software was completed, I asked the Census Bureau, could I use your data to run through the system and do what we did manually in an automated way? And they said, go right ahead. So I did it, and what took 2 months took 6 hours.
Right.
Yep. So, and then now it's repeatable, right? Because once I have the decipher up, I can just bring the next financial close, upload the data, and apply the cipher, and I've got new results immediately. I don't need to be going through this process manually over and over and over again. Okay. So let me introduce a new metric, if I may. Okay, we call it the ARQ index. So we're gonna have to let our eyes roll back in our head a little bit. So if we go back to those 3 ways risk creates cost, and we say, okay, I got the cost to intentionally manage risk, and I've got the cost of incidents that I've captured directly as a cost item in my general ledger. Okay, those 2 items we call the enterprise cost of risk, or ECOR. Okay, if you take that number as a percentage of revenue, we call it the ARQ index general ledger, and that's the orange line you're seeing on here. Okay, if I then look back at that earnings before cost of risk number, and I look at its margin, and I can compare that margin to what the budget earnings before cost of risk number would be, that variance is a performance cost of risk.
Yep.
I can layer that over my enterprise cost of risk to get to the enterprise total cost of risk, and now I can compare those two numbers, because now I can see how much is my performance risk being affected versus how much I'm managing risk. So it's getting back to that trade-off idea, right? If I can keep these things within a tolerance level, so if I look at my percentage revenue and I say I have an appetite to want my cost of risk to stay below 45%, say, okay? And that's my goal. So this organization, you can see, for the most part, was doing that until somewhere in the Q3 of 2012, where things started to fall apart. And where they fell apart was a little bit on the e-core side, but mostly on the performance side.
Yeah.
So we're missing risk, right? So in the risk management process, we're missing risks, or we're not understanding our risk, and we're being hurt by that. So this kind of analysis gives management a quick way to see how well they're dealing with trade-off decisions. And is the trend going north, or is the trend going south? So you can see the trend lines in here.
Yeah. And I think getting that on a timely, on this time sort of trend, I think it is also very useful that you can see then how your organization has evolved, over the last 10 quarters or 16 quarters, both in terms of performance, but also in terms of the cost of risk.
Yes, yes. But very effective. You can learn, once you learn this stuff and you start to understand how to interpret it, you can glean a lot from just one slide. Mm-hmm. It's quite remarkable. And then just to kind of give a final thing, we have a main dashboard in our system that draws in this concept. So if you look down below here, the center dial here is the variance that we're pulling off of the right, and I'll show you that in a second, from the management of risk. So the first way that risk creates cost, is the center dial. And what we're saying is that cost is very, very sacred. And we don't want a lot of variance there. If we say we're going to spend money on managing risk, we need to spend it.
Yeah.
Right? And if we overspend on it, then what's happening? Is that an emerging risk? Are we reacting to an emerging risk? So it's a very sensitive dial in the center. On the left, these are those incidents and losses. So same thing. How sensitive are we to variance in incidents? And we're looking at that. And then lastly, we're going to look at that core business performance.
Yeah.
Right? So we pull all three of these together, we can actually determine what we believe our risk appetite is for all cost as a percentage of revenue. So we extrapolate this dial and the colors in the dial based on the colors of the three dials below. And all this is coming directly from the general ledger. So to the right here, it's hard to focus, but you see those green numbers in here, Manoj. That number right there you see is the earnings before cost of risk. So that's all of our core business stuff on the top. Okay? Then at the bottom is all of our cost of risk stuff. Okay? And then we reconcile so that it still foots to what was reported as earnings.
Yes. Yeah. Oh, so it's almost like a risk-informed financial statement. That it's a version of the financial statement, but
correct,
with sort of that risk breakdown, which I think can also be great. That if we can put this in front of our board and our senior executives, then I think this will also tell a lot about how risk management, is adding value to the organization.
And where the system is powerful, if I find the dial is going awry on the left, I can go over to the right, find the variance that's there, click on it, and I can drill in and find out where it is very quickly. Then from that, if there was an incident, I can now identify that risk event, that incident, as being a performance-driven incident, document it, right, and maybe tee up some action to do something about it. And now I'm allowing for historical actual results to drive also the actions we take to manage risk.
Perfect. Okay. Excellent.
So that's all I have. I don't know if you have any questions.
Okay. No, so I don't see any more questions on the question board. Do you want to just go to the next slide? So where I think you have your contact details. So if anybody is interested in the concepts we talk about, you want to talk more to Gary, then there are his email details. And then, the methodology is covered by this patent. And the reason we wanted to show the software was because the software is also part of the patent. So there's nobody else can implement the same methodology in any other software, because that would be breaching the patent owned by Gary. So that's why we also wanted to sort of show that element of the software, because only there you will get this methodology we talked about. So thank you very much, Gary. I think this is a very important topic, because a lot of organizations are trying to find ideas on how we demonstrate that risk management adds value to the organization, and to get buy-in from the board, the senior executive, get the first line more involved. And I think the concepts we discussed today are definitely play an important role. Yeah.
Thank you, Manoj. I mean, it's been an honor to be able to share some of this with the operational risk community. Hopefully this has got some wheels turning among the professionals that are out there with the struggles that we all have to get management to see the value in what we do.
Yeah, and we were starting to see, at least in Australia, for example, because Australia is always 4 to 5 years ahead than other countries in terms of risk management. So at least on my training courses, I've had a couple of participants from banks in Australia who have already created dedicated teams, whose job is to try and get to the bottom of calculating, the cost of how much money the organization is actually spending, which is why I wanted to do this session, because if Australia is doing this now, I know lots of other organizations will also start doing this over the coming months and years. So we can get other participants also a head start on this concept, that this is not sort of just theory, that there is a lot of thinking which has already gone behind. This. Okay, perfect. So with that, we can close the session. Our next webinar is going to be on 23rd March 2018. So we'll take a break in January and February. So 23rd March is where we are going to talk about best practices on risk aggregation. So you can find the details about that next webinar on the website, and you can also register it from there. So with that, I will close this session. Thank you very much, everybody, for attending. Thank you very much, Gary, for coming and sharing your ideas.
Thank you, everyone.